Promised we've got Varun Goel, head of PMS at Karvy Private Wealth, Mumbai, to talk about his new report on the year 2012, which he describes as a year of new normals. Varun, thanks very much for joining in. If you could just start off by telling us what you believe the new normal is for the rupee-dollar rate that you're expecting, because most experts do believe that it will settle perhaps at a level of 55 to 56 on account of the high fiscal deficit and the redemption pressure that will be faced by India Inc. Do you concur?
Well, no, I think rupee-dollar exchange rate is essentially a function of three factors. One is, of course, the current account deficit, which we are running. Second, of course, is the capital flows both on equity and the debt side. And finally, it is the RBI intervention which decides what level, the short-term volatility in rupee is going to be. So I think based on all three parameters, we believe that we have already seen a very significant depreciation in rupee from 45 to 53 odd kind of levels now. We believe that the new normal for rupee would be somewhere of the same order. It is obviously difficult to give an exact level, but we believe that rupee was overvalued on exchange rate data, and we believe the real effective exchange rate for rupee lies closer to these levels. If you look at the macros, India is running almost a 3.5 to 4% current account deficit, and we have been funding that current account deficit on the back of large capital inflows, both on equity and debt side. I think both for FY12 and FY13, we might just about barely manage to plug in the current account deficit with the capital flows. So our own sense is that we are looking at 53, 54 plus minus a few percentage points as a kind of a short-term band, and we believe that if this band kind of starts breaking, then RBI might actively interfere in the market, and hence for the year to come, for calendar year 2012, we believe rupee is going to be in a very narrow range from these levels.
Right now, Varun, there's about $130 billion in repayments coming due in 2012, the majority of which is accounted for by ECBs and FCCBs, or the majority of which is in the private sector. Also, you've had the Reserve Bank of India in its FSR talk about the likely challenges that the corporate sector is going to face in terms of either refinancing ECBs or retiring many of their FCCBs. How much of a challenge do you believe this is going to be for corporate India, and do you also expect that some of the smaller mid-cap companies are actually going to face a lot of trouble on this front?
I think definitely. So one has to look at the two issues separately. I think FCCB is a little more tricky. There are a lot of companies in the small and mid-cap space which had picked up money during 2006, 2007 at when the stock prices were 3x, 4x of the current levels. So I think those companies definitely will have a tough time in re-raising the kind of money that they had raised during that time. Probably the FCCBs are deeply out of the money, so they will need to replace that with debt. The fundamentals of some of these companies have deteriorated significantly, and hence they may not be able to borrow at those rates. So they might have to replace that foreign debt either with Indian debt or maybe even foreign debt at a significantly high premium as compared to what they paid last time. So some of these companies definitely could be in some short-term trouble. I think the larger issue of ECBs is far more manageable. I think yes, Indian corporates have been borrowing aggressively for the last few years, and the fact is that there is enough liquidity available for good quality Indian corporate paper. Now, if you look at most of the nifty companies, if you look at the top, even the top 100 companies, they have very good credit ratings across the world. We have very few avenues for European banks and even American banks to actually to lend out to companies which are growing at 10 to 15% both on top line and bottom line. So I don't think some of those bigger companies are going to face challenges, and ECB issue as such looks far more manageable and far better as compared to the FCCB issue.
So Varun, what options do you believe India Inc. has in order to meet these repayments? Could domestic loans take for repayment lead to substantial increase in cost for most of these companies?
Well, definitely there is an issue of cost. Now, in fact, if you look at it today, the dollar funding to Indian corporates is no longer available at 3 to 4%. It is available at 5 to 6% today. You add back the hedging cost, which is a significant cost. So dollar funding any which ways was not very cheap. Of course, when you compare benchmark rates in Europe and in India, the divergence appears to be extremely high. But the landed cost of money was, there was never that big a gap. And if you look at RBI has already started easing norms. They've said that Indian corporates can now raise at LIBOR plus 350 bips. I believe RBI is taking a lot of steps to ensure that the pain is going to be minimum. So there is no denying the fact that there is going to be some amount of pain, but I think it is going to be manageable to a large extent. And yes, Indian companies could look at rolling over their debt both in foreign markets. In Indian markets, I think as and when we see the interest rate cycle reversing and RBI coming up with their own easing of monetary policy, even loans in India could get slightly cheaper in the times to come. From an overall interest liability for Indian companies as a whole, if I look at the Nifty 50 companies, almost 24% of the debt that the Nifty 50 companies own is foreign debt. And if we don't think a significant amount of that is going to be replaced by Indian debt. So as far as the interest rate liability, interest liability for these companies are concerned, we are not really looking at a very significantly different number for 2012 as compared to what it was in 2011.
Sure, and finally, Varun, you expect the markets to give a return of 20 to 25% in the year 2012, but before that you're expecting it to bottom out in the first quarter. Where do you see the bottom, and how would you play the up move once the bottom has been hit? Do you think it'll be largely rate sensitives, or will you stick to a defensive portfolio with marginal beta?
I think we're looking at the worst case valuations for the market somewhere around 13.5, 14,000, which is based on 10x 1 year forward earnings. We believe that it's obviously very difficult to say whether that market bottom will come or not, but we have a significant challenge in terms of Q3 earnings. We also have a lot of noise coming out of Europe and US in the first half of the year. So therefore, we believe that first quarter specifically could be a little tricky. But I think overall the 20 to 25% return is based on two things. One is we are looking at a 10 to 15% earnings growth for Indian corporates as a whole this year, and we believe that as interest rates get cut, as GDP growth bounces back from 6 to 7 towards the second half of the year, we are going to see a re-rating of the Indian markets from the 12 times of earnings that we are trading today to 15 times multiple towards the second half, and hence we believe a 20 to 25% return is not difficult at all for the calendar year as a whole.
And in terms of announcements from the Reserve Bank of India, do you expect it to announce a cut in the January policy itself? Because most of the economists and bankers believe that the first cut will most likely be in March or April.
So I think if you look at the data which is coming out, we believe that December inflation number is going to be extremely critical. We are already seeing food inflation having cooled off significantly. I believe if the December inflation number falls below 8, there is a scope for RBI easing. 24 January, obviously they may not go for a repo cut, but I think a CRR cut definitely is a possibility, and that will also give market a sense of what the next round of monetary actions are going to be. So I think from an equity market perspective, market is not going to wait for the actual cut to happen. As long as the market is suitably convinced that the rate cuts are around the corner, we are going to see a bounce back. And we are currently at huge oversold valuations, and we believe interest rate sensitive sectors like banking and automobiles are going to be the first one to bounce back.